Here we are starting week 4 for payroll class. The week 3, you had to do the payroll register and then do the form 941. This is kind of a recap of the last 2 weeks, things that I'm going to briefly go through here and go through the answers to make sure you remember them. The things that I think are important that you get out of this class and that will definitely be on the final. So which form is filed quarterly and that you submit your FICA and federal withholdings with? That would be the form 941. When are your FICA and withholding deposits made? Remember, that is depending on your look back period. So if you had less than 50,000 total taxes in that look back period year, you are going to be a monthly depositor. If it was more than 50, you are a biweekly. And then there are a few exceptions there. If you have over 100,000 in one day, you're by the next day. If you have under 2,500 for the entire year, you can do it with the 941 on a quarterly basis, not even monthly. If you haven't, go ahead and pause this video and go through the rest of these 3 through 9. See if you can get all of the answers, and I'll go through them here in a few seconds. The percentages for Social Security and Medicare. Remember, for Social Security, it is 6.2%. Medicare has 1.45%. Those don't usually change year to year. And then, if any, do any of these have a cap? And the answer is yes, Social Security does. Social Security, remember, it is capped at least for this year, for this current video. It is at $127,200. If you're in a future semester beyond 2017 or the early part of 2018, your number will be a little bit different. Make sure you refer back to your notes because those caps do go up typically on a yearly basis. Every once in a while, the amounts will stay the same, but typically they do go up. Who pays FICA taxes? Remember, this is both the employer and the employee. They both pay identical amounts. So if you pay $10, the employee has to kick in $10. So together the employer will have to pay $20 to the IRS. Typically, what's the earliest age to start collecting Social Security? We went through this last week with the Social Security example. On a typical basis, the earliest you can collect Social Security is 62. What's the latest age to receive the most on your yearly Social Security benefits? The latest that you would ever want to wait is age 70. After that, you're just waiting for no reason, because that's the latest you can wait and still get an increase in a percentage of what. So if you would have gotten back $1,000 when you're age 66 or 67, if you waited till you're age 70, that 1,000 would actually go up based on the percentage that we would have looked at last week. What is the normal age for somebody born in 1975? That would be 67 years old that you have to be before you can start getting 100% of Social Security. Now remember, Medicare is still at 65, but for Social Security it has bumped up to 67 for you to get the full benefit. How is a monthly payment amount determined? Remember, there was that formula that we went through. You have to find your average earnings for the past 35 years, index for inflation. And then you go through and you say 90% of the first, and then I believe it was $885, and then a different percentage for like 20-some% or low 30s for the next between $885 and $3,000 and some, and then any earnings over $3,000 or you get very little, maybe like 15% if I remember correctly. But that's how they're determined. If you want, you can go through. I'm going to skip through this for right now for the payroll register on how to do that. And we're going to jump right into the federal taxes. So federal taxes, this is a little bit outdated, but not too far, but 100 years span here. Back when they first made the tax and made it so it was legal, made an amendment to the Constitution, they had this, only 4 pages of forms. 400 pages of actual code, but only 4 forms that you could possibly fill out. Now there are 4,000 pages, 73,000 pages of tax code. That number goes up every year, as you may imagine. What we're going to be looking at this week in particular now is federal taxes, having money taken out for federal purposes. The prior week, remember, that was FICA taxes, still a federal program, but these actually go towards this money you're not going to really get back. Whereas the Social Security, the plan is you would get that money back when you get older, kind of like a forced mandatory retirement program, as well as the Medicare, mandatory that you pay into it now to get the benefit later. Federal taxes, the first thing about federal taxes that you should know is there are a few people who don't have federal taxes taken out, but they have to pay it on their own. So it's just something for you to be aware of. If you are considered a statutory employee, if you look at a W-2, box 13 will have a indication there if you are a statutory employee. Wanted to throw that in there. The other one here is real estate. If you're a real estate professional, and they're not going to take out any taxes because they consider you a self-employed contractor. So even though you work for Town and Country or you work for Remax, you're considered an individual contractor, and you do not have taxes taken out, nor will they pay their portion of the FICA taxes. So sometimes real estate agents get the bad end of the stick there. Non-taxed fringe benefits. This is something we cover in tax class as well. A few things here that you can get from the employer or the employer will provide you that you do not have to pay taxes on. The first one here is if you get a benefit that it's too hard to keep track of, like if you have you had to use the copy machine for your own personal benefit or the fax machine. The other one here is for if you have a company cell phone. The company cell phone, it can be considered a de minimis fringe benefit, and you do not pay the tax on having. That's a great benefit to get. But you have to meet one of three criteria, and the employer has to be able to prove that yes, you meet one of these three for you to have a tax-free cell phone. And basically, in a nutshell, what those three are. The first one for having a cell phone is you have to have clients or other employees who work in other time zones, like across the world, perhaps, that it wouldn't be practical for you to be in the office at those times when they're in the office. So you need to have a phone available otherwise. The second one is if your clients need to be able to reach you when you're not in the office during normal office hours, they need you for emergency type reasons or what people deem may be an emergency. So that's kind of up to the interpretation. The third one is if you are constantly in and out of the office and your clients may not be able to get a hold of you. Otherwise, you would need to have a phone for them to call you at any time during the normal business day. So that would be the third reason why you could get a de minimis cell phone and therefore not have to pay taxes on it. No additional services. Notice this has to be an actual service. And the key thing here is it has to be in the line of business that you are in at your employer. So even though the employer may have two or more things that they do, say your employer is in car rental and they also do an airline, just for an extreme example. If you work in the car rental side, you may be able to get free rentals as a service if there wasn't a substantial additional cost to the employer if you did that. But you wouldn't be able to get a free airline ticket because you work in the car rental side, not the airline side of that business. So these have to be additional, no extra cost to the employer. They're not going to have much substantial cost, and there need to be empty capacity, obviously. You can't kick somebody off a plane because your employee wants to have a free ride. That's not going to be allowed. It also applies to any children or spouses that you have. If they also get a free ticket, that would be tax-free as well, so that's nice. Qualified employee discounts. Notice generally you're only allowed up to a 20% discount that a normal customer would have to pay on a normal price, you can get an extra 20% as the employee and not be considered a taxable benefit. Reduced tuition. If you actually work at an educational organization, you can get free tuition for you and your spouse and your kid, and you don't have to pay for that. A lot of times there's no additional cost to the employer if you have yourself or somebody else sit in a class that's already going anyway. So that's why they consider that an okay. However, if you are working somewhere that's not an educational place, you can get up to $52.50 from your employer. If they pay that money, you do not have to consider that as extra income. So that's a nice thing as well. Retirement plans, if the employer gives you money to put into your 401k, you're only going to be taxed on that when you withdraw it. Medical plans, if the employer pays some of your medical premiums, which most do, and usually they pay a pretty large part, you do not have to pay taxes on the amount of premiums that they pay on your behalf. A lot of times when you pay medical premiums, you may only pay $100 or $200 every couple weeks, but the employer is paying an additional, say, $500 on your behalf. You don't have to pay taxes on that extra money that you're getting the benefit of. Same with health savings plans. If the employer puts money into your health savings account, that's a tax-free benefit, so that's a nice thing as well. Some taxable things that are fringe benefits, but the company will give you, but you still have to pay the tax on it, like if you got that as actual money. If you get the use of a company car and you don't meet specific guidelines, now like for a police car, it's something different. Police cars, you have those cars and typically you're on call 100% of the time. And the reason you have the car is you can go to any emergency, even if you're at home, you could have the car ready to go. That is considered a non-tax benefit, even though you might use it for personal purposes. But if you had the company car simply because they wanted to give you a perk, you would be taxed at the value that that car would normally get on a rental type basis. So that would be added into your W-2 somewhere as a taxable income there on line 1. Let's keep going down. Specific things, go back up here. Specific payments by your employer for your benefit that are exempt from federal and FICA taxes. Okay, so the second one here, if the employee dies, that last paycheck that they get will not have federal taxes taken out. So it's a small little favor, but still nice, I guess. However, if that last payment that you get will still have Social Security taken out, you won't have federal taxes, but you still will have FICA or Social Security and Medicare taxes taken out. If your employer has a daycare on site, or it's paid for by the employer up to $5,000 of you having daycare, that can be a tax-free benefit. That's a great little perk. Employer parking. This group life insurance premiums, that means if you have a policy out and your spouse or your kids may get up to $50,000 if you would die while you work. Those premiums that the employer pays for you to have that option, those are considered a tax-free benefit, whatever those premiums might add up to. Moving expenses, qualified moving expenses. So if your employer reimburses you or pays for your moving expenses, that is a tax-free benefit. And again, to give you a little overview of the retirement plans, how much the employer can put in or what the employee can put in. Notice for a 401k, it's a really high amount. The employee can only put in up to $18,000 into their 401k. The employer can match that and even go above as long as the total amount doesn't go over $53,000 into your 401k each year. Now, for most of us, that's never going to happen, or we're going to get up to $53,000 in our 401k each year. Notice how much not as good the simple plan is. 401k plan requires a lot of paperwork. a lot of red tape, and so they can get these numbers a little higher because they know, the government knows the company is probably following all the laws. These simple plans, there are a lot less stringent policies, and so I guess you probably could sneak around certain things. So they do lower the employee max, how much you can put in. Instead of 18,000, you can only put up to 12,500. And with a simple plan, the employers must match the employee of up to 3%. So if the employee puts in 3%, the employer has to match it. If the employee puts in 10%, the employer has to put in at least up to 3%. Workman's comp is the last one here I have for these items. Now remember, workman's comp is different than unemployment. Workman's comp is if you get hurt on the job. The money that you continually get while you're off healing is considered non-taxable. Whereas if you are let go of a company and you get unemployment, that is taxable. All right, the next few items that we're going to look at are wages that you have earned, but that you put off to the side and do not collect, but you use that money to pay for other things. So before we were talking about employer providing you extra money, different places. Now this is your money, but you're still not going to be taxed on it because you're putting it in specific spots. So whenever you hear a company talk about cafeteria plans, that's what this means. They give you some options where you can put some of your earned income and not have to pay tax on it. The first main one here we're going to go to is this premium for health insurance. So you have to pay, let's say you have a $150 premium every 2 weeks for health insurance. That money comes out before any taxes are assessed. So if you earn $1,000 in taxable income, but you had $200 taken out for health insurance premiums, you would only be taxed on $800, and that's for federal and for FICA purposes. So that's good. You're not taxed on the full $1,000. You're only taxed on your take-home type pay. Flexible spending, the same thing. You're not taxed on any money that you put aside that will later be paid for medical expenses. However, with flexible spending accounts, it's always noted that you should not put away too much, because if you don't use it, you lose it. Notice here how much you can put away. The max that you're allowed to put aside for medical and it'd be tax-free is $2,600. Now that's for a flexible spending account. Next, we're going to look at the HSA, the health savings account, which has a much higher limit for those who have a high deductible. Flexible spending accounts aren't only medical, you can also use it for dependent daycare. And the amount that you're allowed to use for dependent daycare, you can put aside up to $5,000 a year and not have to pay taxes on it. So that's a really nice benefit as well. Instead of you having to take home the money and then pay the babysitter, you have a third party here that says, yep, you did pay it for dependent daycare. We're going to reimburse you for that, and we're going to reimburse you with tax-free money. Here, I thought it was interesting. I actually called up our human resources individual a long time ago and kind of got the laydown of what happens if you put money into a flexible spending and it doesn't get used. I thought this was pretty interesting. Mainly what happens is when you have a flexible spending account, you have it set up through a third party, through some other third party bank. That bank is going to collect the money for you on your behalf and then reimburse you or pay it directly through like a debit card for your medical expenses. Well, that bank is going to charge your employer a fee to do that. And so a lot of times that money that you might lose will go to help cover some of those costs. Now, like a flexible spending, you have an HSA option if you have a high deductible. And here's what is considered a high deductible. If your deductible is at least $1,300 or $2,600 for a family, you would then have the option to get an HSA. The big benefit of having an HSA over a flexible spending is you don't lose your money. And then here are the caps of how much you're allowed to put away into a HSA. Remember, the flexible spending was only in the 2000s, whereas the HSA is up to $3,400. And then if you have a family, So 2 or more, you can put away up to $67.50 in tax-free money that you would then pay medical bills with. Anytime your employer puts money into that, like we had said earlier in this lesson, that money is not taxed either. Now, the number 5 here is a big one because it's different for federal and different for FICA, is money you put away for your retirement account. If you put money into a retirement account, it is not taxed for federal purposes. However, it is taxed for FICA purposes. So there's a very good chance that you'll have 2 different amounts, one that says FICA taxable and one that says federal taxable. Your federal taxable should always be the same as FICA or lower, never higher. So if you're looking at a W-2, box 1 should always be the same as box 3 or lower. Box 1 should never be higher because box 1 is the federal, and federal you get to take money and not count your retirement withholdings, whereas with FICA you do have to count those monies that were withheld. So that we talked about the 401k, how much you're allowed to put aside, up to $18,000. The IRA, we'll look at this here. You're allowed to put aside $5,500. If you are at least 50 years old, you can put away another $1,000 on top of that, so up to $6,500. This IRA deduction is actually a deduction you take right on your return. It is a 1040 deduction. So you're paying if you put in $5,500 into an IRA, you're actually paying that with after-tax money, so you were already taxed on that money, but then you get to deduct $5,500 on your tax return, so therefore it's kind of like you didn't get the $5,500 because you're reducing it from your income. However, you're still paying the Social Security on that because you were originally taxed on that $5,500. Notice here in Part B, if you want to be in the IRA, not just anybody can. If the company does not have a 401k, then yes, you can have an IRA and there's no limits. If the company does have an IRA and they put money into an account for you, not an IRA, if the company does have a retirement plan and they put money into it for you on your behalf, on box 13 of a W-2, there's going to be an X there in the retirement plan. That says that the company has set up something for you and you have the option of putting money into it. You just maybe have chose not to. If that's the case, then you meet criteria 2 here, that the company has a retirement plan for you. You just haven't set up it. You can still go into the IRA if your AGI is less than 61,000. If it's in between 61 to 71, you're in the phase out. I'm going to show you how the phase out works and just down below. So the phase out is 61 to 71, and those if you are single or head of household. If you are married, those numbers are 98 to 118. You're in that threshold. So if you make less than 98,000, you can still participate in an IRA and your company 401k plan. You can do both if you want. Less than 61,000 if you are single or head of household. Now the calculation, here's the easiest way to do it. The easiest way to do it is a little different than how the book suggests you do it. The way I do it here, the easy way, is you actually skip a step that the book has you do. So as long as you take the top phase out amount, so the top phase amount would be 118 or 71, and then subtract out your AGI, so say it was 110, and then you divide that by the phase out span. The phase out span is how much gap is there between the top and the bottom number. So here would be 20,000. For somebody single, it's 10,000. So I have an example to see how this works out. If we have an AGI of 67,000, and let's say the individual is single, we would take the top phase out amount of 71,000, subtract out their AGI, so that leaves us with 4,000. Divide it by the span, so the span was only 10. So what this means is we are allowed to take and still contribute 40% of the top number. So if the top number was 5,500, because remember that's what an IRA is, if we were on the age where we were allowed to do 5,500, this phase out would tell me of that 5,500, you can only do 40% of it. 40% of 5,500 is $2,200. That's how much you would be able to put into an IRA and deduct on your 1040. I've given you some different of what it means by if you're covered for a retirement plan or not, and then it'll tell you there on the W-2 if you are. A little check mark will be there. Now, the other type of retirement plan option is what's considered a Roth IRA. The Roth IRA is you are allowed to contribute money into a retirement plan. However, you don't get to deduct it on this year's taxes. The positive side of it is any earnings that you collect. So let's say you put it away when you're 30, but when you're 70 and you start taking money out, then when you take the money out, A, you're not taxed on your initial investment because you already were, and B, you're not taxed on your earnings either. The earnings are considered tax-free because you paid your taxes up front. Notice it has the same max contributions per year that you're allowed to put into a Roth. However, the cap, the phase outs are quite a bit higher for those who are single or married. So I have some examples here. I'd like for you to now take the next, we'll go through the first three here, the retirement examples 1, 2, and 3. Take the time at this point to pause the video and see how you answer each one of these, depending on if it's an IRA or Roth IRA situation, and we'll see how you do here in just a couple minutes. All right. If you were doing it at the very beginning of the lecture and you did the payroll register, here is the answers for that. At this time, you'll want to pause and jot down these answers. This is from the very beginning of the lecture, the review. And here was the journal entry. All right, we're looking at the IRA example number 1. With this one, individual is 60 years old, so that already puts them into that higher category, the 5,500 or 6,500. This individual does not have a qualified retirement plan with her employer. Her AGI is 188,000. Now, remember, with an IRA, if you do not have a qualified retirement plan option with your employer, you can deduct and put in the full amount, the 6,500. Now, remember, that 6,500, that pales in comparison to how much you can put away potentially with a 401k. If your employer has a 401k, you could put up to 18,000 away, where here you're only allowed to put away 6,500. With a simple plan, you're at least allowed to put away 12,500, whereas here only 6,500. So quite a bit of a difference between the 401k to this. The Roth IRA. Again, it doesn't matter for a Roth if you have a company employer-sponsored plan. What matters is your AGI. This individual is in the cap range. So what we need to do, she is married, so we need to take the upper limit. So we go back to the notes. The upper limit for married persons was 194 for this year. Now your numbers may be different if you're in a future semester. Always go back to the notes that I have for that year. Do not rely on these screen notes that you see. 194 minus what her AGI is that I have listed for this year. That's $6,000 difference. Now, when we look back to the phase out down here, that's only a $10,000 gap. 6,000 divided by 10 says we can only deduct 60%, or not deduct, but we can only contribute as a Roth IRA 60% of the normal. 60% of 6,500 is 3,900. Example number 2. So we have a age 45, so that tells us he's in that lower number, the 5,500 option. He has the option of a qualified plan at work. AGI is 69,000. All right, so with the IRA, he falls in that first cap range. Remember, if you have a plan, you fall within that the first phase out ranges, and it started at the high number was 71. Subtract out what his AGI is at 69. 2,000 left over the span of 10. So he would be allowed 20% of the 5,500. He can only deduct $1,100 on his 1040. Whereas with the Roth IRA, he doesn't come anywhere near the cap. The cap is all the way up over 100,000, so he can put in up to 5,500 into the Roth IRA. Now he can't deduct anything, but any future earnings would be tax-free. Tanya, 55 and single. All right, so she hits the qualification, so she's up in that higher threshold, the 6,500. Has the option of a qualified plan, but doesn't do it, but she does have that option. AGI of 120,000. Key here is she is single. She is way over the phase out for the IRA. Remember, the phase out is 71,000. She cannot do an IRA, but she could do a Roth IRA. A Roth IRA says come down here again. I'm down in my notes where the arrow is. The IRA is for single 117 to 132. There's a $15,000 span. So 132 minus where she's at of 120. There's a $12,000 difference over 15,000 span. So that's 80%. So she can almost get the full amount and put it into the Roth, but not quite. She can put in 5,200 into her Roth. Okay. Our next here, this first lecture example number 1. What I want us to be able to do is, all I want you to do is, what is Jack's taxable salary for each taxable salary for the following? When we have somebody here who earns $1,500, what we're going to start doing for each of these categories is start subtracting out items that are not taxed. So for FICA, we don't pay tax on any medical premiums. We have to ignore this because we do have to pay taxes on any 401k. The $50 union, we don't get to deduct for that. $100 in flexible spending, we do get to deduct for that for FICA. $100 in HSA contributions, we do get to deduct for that. It doesn't matter what the employer contributes, that's extra information. And $150 gets deducted for child support. We can't do anything with that though. So for our FICA, for FICA purposes, at least we're not being taxed on the full $1,150. We get to subtract out the medical premiums, the dependent daycare for flexible spending, and then the HSA. And then for federal, it's the exact same as the FICA, except you get one extra item on here, and that's the 401k plan. This is the amount that we would actually times by 6.2%. This is the amount that we would actually look up to see what the tax is on $1,050. Okay, at this point we have gone long enough. I'm going to cut this lecture into 2 because we're going to do some examples and I want you to be fresh for those examples. So for part 1, we are going to stop it here, and then we will start 2 here with withholding allowances.